Okay friends, so continuing with the last video, the second one. The eighth important provision in FAS 10 Financial Accounting Standard number 10 is about the recognition of immediate losses. When somehow the estimates don't work well and the total cost override the total expected revenues, then an impairment loss, an immediate loss has to be recognized. So what are these specific provisions? It says that when accumulated cost plus estimated cost of completion of the contract, the accumulated costs are actually there in the work in process account or the Istisna cost account if it is a parallel Istisna. So if those costs which have been incurred so far plus the further estimated cost to complete, right? If they exceed the total fixed contract price. So if my existing costs are say 100,000 and further 50,000 costs is to be incurred, so 150,000 will be the total cost and the total revenue is less than 150,000. It means there has to be a confirmed loss. So that loss has to be triggered and recorded then and there. So the rule is Istisna's work in process must be measured at the value not exceeding its cash equivalent value, which is the contract price minus expected additional cost to complete. So total contract price that I am going to receive less the further cost that I have to incur is the net amount that I am going to receive. And if my costs are exceeding it, I have to record an immediate loss. And that loss has to be recorded entire expected loss, which is the value of contract price minus expected additional cost. And this has to be compared with the work in process. So work in process plus expected additional cost should not exceed the total contract price. If there is a difference, that has to be recorded as a loss. And that loss is to be immediately recognized in the income statement in which the cost overrun. And this is regardless of whether we are using the percentage of completion method or the complete contract method. Since it is an impairment loss, so being a conservative approach, it has to be recorded in there. Point number 9. What happens if the asset delivery does not take into place the way it was planned? So the delivery by Al must know on time and conforming site, right? So asset is recorded at the historical cost book value of the Istisna's cost account. Now it is for the parallel Istisna, right? That is, the bank has received the constructed project, the asset, the Al Masnu from its parallel seller, but it has not delivered to the main client. So the physical asset come into being. So now the work in process has to be removed and a physical asset has to be recorded in the books of the banks. Balance is transferred to an asset account reflecting the physical nature of the goods, right? And then eventually when we will sell it to deliver it to the eventual client, then it will be credited and automatically accounts receivable will be debited, or accounts will be debited, billing will be credited, and eventually they will be set off, as we have discussed in the live class. If it is a late delivery on subcontractor part, right, then if there can be some claim for compensation from the performance bonds, then yes. If bonds are insufficient, recording the shortfall as Istisna's account receivable due from the subcontractor, and if that cannot be received, then it has to be charged off. So three situations. Number one, if we have some sort of security, if we have some sort of compensation, then we can actually trigger those compensation. If we don't have, but still we are supposed to receive, then we will debit the account receivable for the losses that have been for the late delivery. And if that is also not probable that the subcontractor will pay, then we will actually record a provision. So this is only if there is a provision about the fault of the subcontractor and the late delivery. If there is no provision and all the parties agree, then the situation will go straight. Point number 10. What if the asset is delivered maybe in time but not conforming to the specifications? So in that case, asset is measured at the lower of its cash equivalent value or historical cost. So historical cost, something that is already is there in my WIP account or the Istisna cost account. And if the specification do not meet, then maybe my client will not pay as much as agreed. So I have to record the cash equivalent value, the amount I expect to receive from my client, or the historical cost, whichever is lower. Any uncompensated loss is instantly recognized in the income statement. So of course when we do this, then of course the losses are automatically recognized in the income statement. If they are non-confirming but declined by bank, right, it means that again this is the parallel Istisna contract, right? and I think this entire discussion is in the context of parallel istisna, right? That we have accepted an asset from the subcontractor which does not meet the specifications, so we have to see whether we are going to receive the cash equivalent value or not, and we have to recognize the loss. If the bank declines, then the unrecovered progress payments are moved to Istisna's account receivable. So we say, okay, the contract is terminated, you failed to deliver, so whatever we have paid to you actually now becomes our account receivable. So wherever it is lying that we have paid, it becomes our account receivable. And if some part of it is not collectible, then we have to create an allowance for expected credit losses. And finally, if the client refuses in the parallel istisna that we have accepted, but the client eventually refuses, the asset remains with the bank. We have accepted, client refuses, it's now my asset measured at the lower of cash equivalent value, whatever cash equivalent value I can sell it in the market. Now the cash equivalent value is not something which is agreed upon between me and the client, because the client has refused. So cash equivalent value in the market and historical cost and realized loss hits the income statements, right? So it's not the realized loss at this point in time, this is unrealized loss, but eventually when we dispose it off, that becomes a realized loss. So this was point number 10. The second last point, the balance sheet presentation, as we already know and discussed, this Istisna WIP or Istisna cost account is on the debit side, which shows the total cost plus profit. The Istisna billing is on the credit side, which shows the total cost plus profit invoiced, right? So towards the end of the Istisna, they will be equal. So their balance will be towards the end will be zero, regardless of the payment is paid or not. This is about the billed and incurred. So this net position will be shown before, if this is not complete, this net position will be shown in the balance sheet, either as an asset, if WIP is more than billings, or billings is more than WIP, it will be shown as a liability, something to deliver. And of course, if there is a parallel istisna, so we cannot compensate or set off istisna account receivable with istisna account payable. Last, disclosures. So revenue and profits recognized for the period for istisna accounting method used, whether percentage of completion or completed contract, cumulative actual cost, revenues and profits to date. So the WIP balances and its breakup, amount of retentions or contracts in progress. Retentions means that we have billed, the party is not paid, so we may clarify that the party will not pay because the 25% will be paid maybe after 1 year of completion. Gross receivables and payables, they have to be shown apart from the balance sheet without offsetting, right? In the statement of financial position balance sheet. Details of unsettled claims or contingent fines for delays, if there are any disagreements, they have to be shown. Specific method used to determine the percentage of completion, again, is it based on engineering studies or just the cost estimates. The total value and time spans of parallel istisna in progress, so for each istisna, if there are parallel istisna, so we have to mention it. And signed contracts not yet commenced, that is the commitments that are under process for istisna, but they have not been the work has not been started, or the financing has not yet been provided. So that's it. Hope this will give us a fair idea of the this code standard.